Silver alert. Will Tuesday bring a recovery or the collapse continue? Be ready. Silver just did something it hasn't done in months, and depending on what happens Tuesday, either a massive opportunity just opened up or the pain is only getting started. Most investors are watching their screens right now, confused, nervous, asking the same question. Is this a dip to buy or the beginning of something much worse? I'm going to answer that question today. But more importantly, I'm going to show you why this moment is more significant than the price chart alone suggests. Stay with me, because by the end of this video, you'll understand what's actually driving silver right now, what Tuesday's session could reveal, and how to position yourself before the crowd catches on. Here's what most people are missing. When silver drops sharply, the headlines call it a risk-off move. Analysts say investors are fleeing to safety. The financial media runs its usual story about dollar strength, and everyone nods along. But that explanation is incomplete, and for serious investors, incomplete information is dangerous. Because underneath the surface price action, there are three forces pulling silver in completely opposite directions right now. Industrial demand that isn't slowing down, a paper market under structural pressure, and a macroeconomic backdrop that is becoming increasingly hostile to fiat currency. Most retail investors see the price drop and panic. Smart money sees the divergence and starts asking different questions. Today, we're going to ask those questions, and the answers might surprise you. Section 1. What actually happened? Let's start with what actually triggered this move. Silver has been under pressure, and the selling has a technical explanation on the surface. Dollar strength, rising short-term yields, and risk assets broadly under pressure. When the dollar strengthens, commodities priced in dollars become more expensive for foreign buyers. Demand looks softer. Traders hit the sell button. Simple enough. But here's the part the headlines skip. The COMEX, which is the primary futures exchange where silver's global price is discovered, is not a physical silver market. It is a paper market. Contracts change hands by the hundreds of thousands, representing enormous quantities of silver that in many cases will never be physically delivered. What this means is that short-term silver prices are driven not by the guy in Germany buying a solar panel or the electronics factory in Taiwan ordering 10,000 ounces for circuit boards, but by traders managing futures positions, hedge funds running algorithms, and institutions hedging broader portfolios. The price you see on your screen right now, it's largely a reflection of paper trading activity, and that distinction matters enormously, because real-world silver demand, the kind that actually consumes physical ounces, has not dropped. It hasn't even slowed meaningfully. So what we have is a paper price correction happening against a backdrop of stubbornly strong physical fundamentals. That gap, that divergence, that's where the opportunity is hiding, if the fundamentals hold. Section 2, the physical reality they're not talking about. Let's talk about the physical market for a moment, because this is where the real story lives. Silver is not gold. It's not just a monetary metal that sits in a vault and waits. Silver is consumed, it is used up, and once it's embedded in a solar panel, soldered into a microchip, or printed onto an EV battery contact, it is gone from the investable supply forever. And right now, the world is consuming silver at a pace that the mining industry simply cannot match. The Silver Institute, one of the most credible research bodies tracking this market, has documented consecutive years of supply deficits. The world is using more silver than it produces, year after year. In a normal commodity market, sustained deficits drive prices sharply higher. That's economics 101. Scarcity should equal premium. But silver has an unusual problem. Its price is set on a paper exchange where physical delivery is the exception, not the rule. So the deficit can persist, and has persisted, without fully transmitting into the paper price, until it can't anymore. And here's the question that every serious silver analyst is quietly wrestling with. How long can a structural, physical deficit coexist with a paper market that seems indifferent to it? History suggests not forever. At some point, the math wins. It always does. Now, does Tuesday's session resolve that question? Almost certainly not. But it might give us a signal about the short-term direction. And understanding the underlying structural story gives you an enormous advantage in interpreting that signal correctly. Section 3. What Tuesday is really about. So what is Tuesday's session actually telling us? Think of it this way. Every significant price level in a market is a test. It's the market asking a question. Is there real demand here, or will sellers overwhelm any buying interest? When silver fell to its recent lows, the market is essentially running that test. And the response, the volume, the speed of any recovery, whether buyers step in with conviction or the selling continues, tells you something important about where the dominant pressure is. If Tuesday brings a genuine recovery, strong buying volume, silver reclaiming a key technical level, that's a signal that the selling exhausted itself. That buyers, whether physical stackers, institutional hedgers, or opportunistic traders, viewed the drop as excessive relative to the fundamentals. But if Tuesday brings a continuation, more selling, lower prices, a breakdown through support, then we have to ask a harder question. Is there something in the macroeconomic picture that we're underestimating? And honestly, there might be, because the Federal Reserve is still in a complicated position. Inflation has proven more stubborn than the Fed's own projections suggested. Rate cuts that markets were pricing in aggressively just months ago have been pushed back, delayed, repriced lower. And when interest rates stay elevated, the opportunity cost of holding non-yielding assets like silver rises. In plain English, when you can earn 5% in a money market fund, why hold silver that pays nothing and can be volatile? That logic pressures price in the short run, and it's real pressure, not just noise. The question is whether that short-term pressure matters more than the long-term structural deficit story. And this is the tension that Tuesday will begin to resolve. Section 4. The macro framework, why silver's moment may still be coming. Here's where we need to zoom out, because the day-to-day price action is one thing. The macroeconomic trajectory is something else entirely. Let me paint you a picture. The United States is running a federal deficit that, as a percentage of GDP, is extraordinary by peacetime standards. Interest payments on the national debt are now the single largest line item in the federal budget, surpassing defense, surpassing Medicare. Think about that for a moment. The cost of the debt is now the dominant cost of running the American government. This is not sustainable, and it creates a set of very limited options. Option 1. Raise taxes significantly. Politically difficult, almost certainly insufficient on its own. Option 2. Cut spending dramatically. Equally difficult and with significant economic consequences. Option 3. Inflate your way out. Allow the currency to degrade over time, reducing the real value of the debt. This is the path of least political resistance, and historically, it's the path that governments tend to take. If option 3 unfolds, and the evidence from monetary history suggests it is more likely than the other two, then hard assets become critical. Gold has been the traditional inflation hedge, and gold has been performing accordingly, reaching price levels that have shocked even veteran precious metals analysts. But here's what the data keeps returning to. Silver has historically followed gold's monetary repricing, often with a lag, and often with greater percentage moves when it does break higher. The gold-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, remains historically elevated. That elevation represents either a correction waiting to happen, or a permanent structural change in how the market values the two metals. Most serious analysts believe it's the former, not the latter. Section 5. The geopolitical dimension. And then there's the geopolitical layer that most mainstream financial commentary barely touches. We are living through a period of active de-dollarization. It is slow, it is incomplete, but it is real. Central banks around the world, particularly in countries that have historically been close partners of the United States, have been accumulating gold at record rates. Not US Treasury bonds, not dollars, gold. When central banks move, they're not making short-term trades. They're repositioning their balance sheets for a world they believe is coming. A world where the dollar's dominance is more contested. Where holding dollar-denominated assets carries more geopolitical risk than it did 20 years ago. Now, silver doesn't benefit from central bank accumulation the way gold does. Central banks don't hold silver reserves. But silver benefits from the same underlying shift in confidence, the gradual, then sudden recognition that fiat currency systems have limits. And beyond monetary demand, silver has something gold doesn't, an industrial demand base that is structurally growing. The energy transition is real. Solar panel installation globally is accelerating. Electric vehicle production is scaling. Artificial intelligence infrastructure, the server farms, the cooling systems, the high-density electronics, all consume silver. These are not speculative demands. They are contracted, capital-committed, long-term industrial programs that are already underway. You cannot manufacture your way out of this demand picture without silver. And the mining industry, which takes 7 to 10 years to bring a new mine into production, cannot respond quickly to rising demand. The supply response, when demand accelerates, is always delayed, and that delay is where commodity price explosions happen. Section 6. 2 scenarios for what comes next. Let me lay out the 2 most credible scenarios for what happens from here. Scenario 1. The recovery holds. Tuesday brings buying pressure. Silver reclaims a key level. The market interprets the recent drop as an overcorrection relative to fundamentals. Momentum shifts. Traders who are short start covering their positions, which means they buy silver to close their trades, adding upward pressure. Physical buyers who have been watching from the sidelines, waiting for a pullback, see the dip as the entry they've been wanting. In this scenario, the structural thesis remains intact. The paper market has essentially offered a temporary discount on physical silver, and patient investors who use the weakness to accumulate rather than panic are rewarded as the macroeconomic forces reassert themselves. This scenario is historically consistent with what happens in commodity markets during structural deficit periods. The paper price can diverge from physical reality for a time, but the fundamentals tend to reassert themselves. Scenario 2. The pressure continues. Federal Reserve communications signal that rates will stay higher for longer than markets had hoped. The dollar continues to strengthen. Risk appetite globally contracts. Silver, which is more volatile than gold and more sensitive to industrial sentiment, continues to underperform. In this scenario, the thesis doesn't break, but its timing extends. The structural deficit is still real. The monetary dynamics are still building, but the catalyst for repricing gets pushed further out. This scenario requires patience, and it's a test that separates investors who understand what they own from investors who are simply reacting to price. Here's the honest truth. Both scenarios are possible. Anyone who tells you with certainty what silver will do tomorrow is either lying or fooling themselves. What I can tell you is which indicators to watch and what they mean if they break one way or the other. Section 7. What to watch. Tuesday. So concretely, what should you be watching? First, volume on any recovery attempt. Price moves without volume are suspect. If silver bounces Tuesday on thin volume, that's a technically weak recovery. If it bounces on heavy volume, particularly in the early hours of the session when institutional players are most active, that's a more credible signal that real buyers have stepped in. Second, the dollar index. Silver's short-term price is highly correlated with dollar direction. If the dollar softens even modestly, silver gets relief. Watch the DXY, the dollar index, alongside silver price. If silver is rising while the dollar is also strengthening, that's a powerful signal. It means buyers are overcoming the currency headwind through genuine demand conviction. Third, gold's behavior. Gold and silver tend to move together, but their relative strength matters. If gold is recovering while silver lags, that tells you the selling in silver has a component beyond general precious metal sentiment, possibly industrial demand concern or heavier futures selling in the silver market specifically. If both metals recover together, the bid is more broadly based and therefore more durable. Fourth, any news out of the Federal Reserve. Comments from Fed members carry enormous weight right now. A single sentence suggesting flexibility on rates can move silver sharply. This is frustrating for fundamental investors, but it's the reality of the current environment. Fifth, and perhaps most importantly, watch physical silver premiums. If spot price is dropping, but premiums at dealers are holding steady or widening, it means physical buyers are not following the paper price down. That divergence is one of the most bullish signals possible for the structural story. Here's where I'll leave you. Silver has always been the more volatile, more complex, more misunderstood sibling of gold. It doesn't get the mainstream coverage. It doesn't have the institutional halo. It lives in a strange space between monetary metal and industrial commodity, and that ambiguity makes it difficult to own during moments of uncertainty. But that ambiguity is also the opportunity. Because when both the monetary thesis and the industrial thesis are building simultaneously, as they are right now, the potential repricing is not small. It is not a 10 or 15% move. Historically, when silver moves in alignment with a genuine monetary regime shift and an industrial demand supercycle, the moves are measured in multiples. Tuesday is one session. It will tell us something. It won't tell us everything. What matters most is whether you understand what you're looking at, whether you can watch a sharp drop without losing your analytical clarity, whether you can separate short-term paper market noise from long-term fundamental signal. If you can do that, you already have an enormous advantage over most retail investors. The question I want to leave you with today is this. If the physical silver deficit is real, If the monetary system is under structural pressure, and if the gold-silver ratio is historically stretched, then the current price is either a risk or an opportunity. And which one it is depends almost entirely on your time horizon and your understanding of what's actually happening beneath the surface. Tuesday will give us a data point. The macro story will continue either way. Stay informed, stay analytical, and stay ready.